Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today is our favorite day, Friday, when we get to go through the Primary Vision frac spread count. And on today's show, we had another decent data dump. So we're going to go through the frac spread count, the rig count, go through what's happening a bit in China on the coal side, on oil and fuel oil. And then we're going to talk a bit about what happened or what the data came out with following GDP's, the US GDP print yesterday. We did a deep dive on the GDP side in yesterday's econ show, so we're not going to rehash that, but we'll try to tie it back. And unfortunately, I thought I was going to have a nice short show, and then all this great data comes out, and then all these great charts come out. And I was like, all right, well, I'll make it a little bit longer. Hopefully, everyone will be able to get through it quickly and enjoy Halloween with the family. I know that I actually enjoy Halloween now that I have kids, and as I used to hate it as growing up, but now with 3 girls, it is actually a lot of fun. So hopefully everyone has some great plans for Halloween. And as always, we appreciate it if you like, share, and subscribe. You know, your support is appreciated. So now that we look at what is happening on the frac spread count side, so we had an increase of 1. So we went from 265 to 266. And now for clients, I would highly recommend looking at the breakdown, because we had some decent shifts in terms of some areas that didn't have any activity now have activity. Some areas, the smaller basins that had some 2 or 3 spreads have now come down a bit. And then we've had some increases in some areas like Fort Worth and the Williston. So again, these are just natural changes that we see, especially as we've been talking about the smaller basins, that they come on. And then as soon as they come on, they'll stay. You'll get 2-3 spreads. They'll do work for 2-3 weeks and then start to come off. And then we'll keep seeing that push back and forth. So again, a lot of interesting things happening. Not too much to write home about. As we were saying, we expected to kind of flatline here, see some increases. Again, that top end being still 275. Which we think will hit over the next 2 weeks, and then run as much as they can, and then start to roll off as we head into that Thanksgiving to Christmas lull. Now, again, that lull just won't be on a percentage basis as far down as it has in the past, just given that we're just at a much higher level than we have been in previous years. So now, I should say lower side than previous years. So now that when we look at what's happening on the Baker Hughes rig count, so when we look at the rig count, you can see that on the U.S. basis, we're up by 2. We had 1 increase in oil, 1 in gas. It was horizontal and vertical. So really nothing too crazy. Again, we have a bigger shift coming, which is where we've been talking about this. You have that 1 or 2 weeks of this kind of moving day, and then you start to see some of these increases as we go through the end of the year, because now the focus is going to shift to making sure that there's enough DUCs, there's enough activity to really bring us into 2022 and have that growth set up. And really not this exponential growth, but really just this steady grind higher to make sure that there's enough DUCs to work, there's enough activity to keep things going. And it's interesting or good to see that we keep seeing that vertical side as they're getting or trying to maintain that efficiency of having that vertical and then bringing the horizontal behind it to really speed up that process, which is something that we've continued to see. Now, when we look at China, when we look at crude stocks, you can see that crude has come down again in Shandong, and that's something when we talk about the backdrop. We've seen a really elevated amount of crude and floating storage. So there is this delay in terms of getting it from floating storage into Shandong. We do know that recently they just brought 2 ESPOs into port, so that should help kind of stabilize this. Again, not really moving it higher, but just flatlining it at this point, just to maintain some of the activity that they've seen. And as we were talking about, China has been rationing diesel and gasoline, and it's really a matter of trying to manage what is there, make sure that they have a certain amount of coal that's available. According to the NDRC, there is now 100 million tons available at power facilities. So again, how much of that is true, we'll have to find out, but we have seen coal prices come down, and we'll talk about that in a minute. But again, these are some of those important factors. And then when we look at what's happened in Angola, just off of this backdrop, some of the physical prices have come down again for December loading. We had one come down to about $1.50 less dated Brent, and then a different grade at about $1 above dated Brent. Both of which are about $1.50 cheaper than where they were. So again, you continue to see some of these problems when you're looking at West Africa. And it's interesting because this is also light sweet crude, so you would assume that there would be a little bit of an opportunity because there has been that issue when you look at some of the higher sulfur stuff. So again, these are some of those important points when you're looking at what is happening. And the reason why I bring up Angola right now is because we do have on November 4th the OPEC meeting. So based on what we're seeing, we expect them just to keep things consistent, stay with an increase of about 400,000 barrels a day. And the reason why is when you look at what's happening in Iraq, SOMO traded at only a 15-cent premium to OSP after being at about a 60 to 90-cent premium. So it's still, and before that, there was at a 60-cent discount. So there is some tightness in that. It's just not where it was. So you're starting to see that that kind of pare back a bit. So just based on where the physical market is, where the crude curve sits, I don't think that they're going to go much above that 400,000 barrels. And then they're going to really start to talk about what does January look like and February as we go into the end of the year. And one of the important things that we saw right now is when we look at what happened in on the fuel oil side in China Shandong, you can see it's come down a bit again, but still at seasonally adjusted all-time highs. So those are things that we continue to look at. When you look at Singapore, there was a build of about 1 million. And all of that was really driven by middle distillate, as we saw with Fujairah, where when we look at Europe had a drop on the gas oil side, a build on the gasoline side, but they've also just increased the amount of purchases that they've done from the UAE, and you're starting to see those show up. So as we were saying on the EIA show, we expect gas oil to really kind of flatline. And again, it's still in a very bullish position when you look at where it is versus normal storage. But that's something that they're going to manage, and while they continue to send fuel oil into east of Suez, because that arb still remains wide open. And the reason why that's important is because that's what they've struggled to get rid of, where their focus is really on that gas oil, gasoline side. So now that you're starting to see the gasoline build back up, that might help the arb coming from Europe into the U.S. again. And with that excess gas oil will also help open up moving that flow from Europe into the U.S. When you look at Pad 1, Pad 1 is the one that is really causing that shortfall on the storage side. But it's important because Pad 1 is also the place where we use the most fuel oil, heating oil. So again, these are things that we always want to pay attention to. Now, when we look at thermal coal, you had another move down. You're now below 1,000. Again, it's all a parade. What now they're talking about collusion. They're talking about investigations. Again, the NDRC said that they were going to do things at all costs. That had a lot of implications, including life and politics. They've increased the amount at port and rail. So the view is that there could be even more than the 100 million being quoted. But then when you look at India is still in a very tight situation. So it's just going to be a matter of how does this play out. And by play out, I'm talking about weather. How is weather going to play out? Because we know that there is a slowdown in terms of the industrial side. It's just where is weather going to come? How quickly are they going to have to ramp up? Or are they going to have additional time to build up some storage? On the other side, one of the things that we talked about yesterday on the Econ show is the amount of liquidity that has come into the market from the PBOC. As we were talking about on the credit impulses side, they want liquidity to come down but not freeze everyone out. So there's going to be kind of that balancing act of where does it make the most sense. And at the same time, we're coming into month end, and typically there is an increase. Excuse me, there's an increase in liquidity as we come into month end to make sure that businesses have enough available, banks have enough available. So the first week of November is going to be important to see how much of this stays in the system. And some of it will come out. I think some of it will stay in because as we were discussing yesterday, the issue is going to be how much do they want to use the RRR cut? How much are they trying to use tax cuts? And how much are they going to use liquidity? And so far, what they're really positioned to use tax cuts, tax forgiveness, and then at the same time liquidity, and try to leave that triple R for a rainy day, or if they really have to. So far, I think this is some of the stimulus that we can expect to see. Now, shifting gears to the U.S., the newest data that has come out is a bit concerning, and again, it's concerning in different ways, and then there's some positives within it. So first, personal income dropped by about 1%. That is a bigger drop than was expected. And it really comes down to government transfers. As we've been talking about, government transfers is the one that it was going to have the biggest impact. The expectations was for a decline of negative 0.3%. Instead, it came in at negative 1%. Personal spending in line with expectations of 0.6%. Real personal spending in line with expectations of 0.3%. The only real surprise came in when you look at what happened with the University of Michigan, where University of Michigan data came in slightly worse than expectations, but we'll go through that in a minute. So when we look at employment cost, this is the employment cost in general, increased 1.3%. Again, that is a negative contributor when you're thinking about inflation, because that is going to keep inflation going higher. But there's some conflict, because if the cost of employment is going up, it means wages are going up, but yet personal income came down. And this is what we've been talking about. When you look at personal income, it's gone up, but it hasn't come in at the same level, where when you factor in inflation continues to outpace even where wages are, which is why there's that employment cost that continues to go up, because again, it's trying to keep pace with inflation as well as where things are going. But as income is dropping, personal consumption is positive. So you have income coming down by 1%, and then you have personal consumption up by 0.3%, in line with expectations. But where is that additional money coming from? And it's coming from savings, which is why we want to look at what is happening on that savings rate, which I don't think anybody's surprised to hear. It's come down again, because that's where a lot of these individuals are pulling that money from. So based on conversations I've had on Twitter, the most recent thread that we put out, it's really, we're starting to see, again, those payday loans come forward, those cash advances, because people are trying to spend money as quickly as they can for the holidays, get in front of the supply chain, which is why we do expect to see some of this strength in October, but this drop off in November. And I think this is really kind of supporting how we finish September and how October has continued. On the other side, and we talked about this in the Econ show as well, but I thought this was a great chart. The 3Q 2021 renewal rates exceeded 52% benchmark in almost all metro areas, which just means that we've hit a record number of renewals during the early pandemic days. And those levels dropped later in 2020 as mobility picked up. People wanted to move to cheaper locations or buy a home. And now we are back to record high renewals, because people that wanted to move already did. People that want to move see no inventory, and people that want to move see increasing rents elsewhere. So again, this is what we've been talking about of everybody that wanted to buy a home has bought a home. And now who is the next incremental buyer becomes the biggest question going forward. And at the same time, you've seen those savings come down. So this was, I think, an interesting one, where amid weaker personal income in September, consumers dipped into their savings to finance their outlays. So again, you're not only now have that personal savings coming out, you have the payday loan, you have the cash advances, again, draining a lot of this excess that has been kept in the system. U.S. personal savings rate fell 1.7% to 7.5% in September, and dipped below the pre-COVID level of 8.3% for the first time in this recovery. So we are now back below where we were. So essentially everything that has been put into savings has come out, and then some. And the reason why I say and then some is because there's a bifurcation between where is the savings, and a lot of that savings at the upper end, let's call it the top 20%, still remains there, which means that they have now taken it all out from the bottom 80%, which creates some of that concern going forward through the remainder of Q4. Then when we look at understanding the personal income dynamics, despite steadily rising labor compensation, personal income growth fell that 1% in September as emergency unemployment benefits expired and the boost from the federal stimulus programs faded. Disposable income adjusted for inflation fell 1.3%, but still remains 1.8% above pre-COVID levels. So again, there's some mixed bag in that, but again, this is where we continue to see some of that pressure as we look at consumer spending going forward, which still has some space to give, just coming back to that trend, which is where we think it's going to go. It's just going to fall back to that trend level and really not maintain some of this excess, really driven by durable goods, non-durable goods coming down a bit, and services continuing to come back above pre-COVID levels. So consumer spending is now 3.5% above its pre-COVID level, but more importantly, it's just 0.4% below its pre-COVID trend. So again, I think you just get some of that switching in general. Deviation from pre-COVID, spending on goods is up 8.8%, durables is up 7.7%, non-durables 9.4%. Again, spending on goods in total is 8.8%. And then the spending on services is still 4.5% below pre-COVID. And again, it's just, I think you just get more of that marriage in the middle. But then when we look at where this inflationary pressure is going to remain, it's when we look at wages and salaries on the private industry, which is leading that 6 months, which is why we believe you still get that median CPI being pulled higher. The real employment cost continues to outpace estimates, and it's up from the prior. So again, you're seeing that trend coming up, which is just pulling it up. And now how much of it can be pushed through, that's always the conundrum. But again, we still see this moving forward. And this is just pulling it out so you can see it kind of clearly on the year over year, the wages and salary. So if wages keep rising at this Q3 pace, the Fed is going to, again, coming to this pressure point of this very, not so very small push, as 1.5% quarter over quarter really equals 6% year over year. So unless productivity growth is rebounding to the late 90s pace, which has been tough, because if you think about when technology really hit its stride, it's in that late 90s when everybody was finally seeing that productivity. That's going to be near impossible to replicate. So it's unlikely we get that benefit. And that's going to, unfortunately, that's going to increase the amount of underlying inflation on the wage side. Then when you look at that spending rotation, again, just kind of reiterating what we've seen, the consumer spending still remains strong even though that personal income dropped. Compensation slightly up, but again, those unemployment benefits dropped, and that government transfers was the biggest issue as PCE prices were up 0.3%, which is the smallest since February, but when you look at it going back, it's still the highest since the 1990s, and we've seen a re-acceleration in October, which again is going to just mean that when you look at PC prices, that GDP cost, that's when you're going to see that accelerate again in Q4 and closing out on a strong note for 2021. This is looking at that employment cost index, just to give you an idea. It's on wages and salaries. Wages and salaries are that driver. People need to be compensated for the inflation that they're seeing, their living expenses going up, which is, again, that underlying driver of why we see this stickiness in inflation. And as we talked about with rents and this difficulty that you're seeing people re-up, and they're re-upping at a higher rent than previously. Now rounding out, when you look at the University of Michigan consumer sentiment, it's dipped a little bit. So the consumer sentiment index fell 1.1% to 71.7 in October. The expectations was for 71.4. So again, you're not seeing too much in general. When you look at the positive impact of higher income expectations and receding COVID, offset the view that higher rates of inflation and falling confidence in government policies. So you're starting to kind of get this mixed bag. Current conditions was down 2.4 points to 77.7. And expectations was only down slightly to 67.9. So again, you're not seeing too much. It's just kind of here, and this is what we've been expecting, where we already had that big drop, and now people are seeing some of their wages go up, but they have some concern about about to go forward, and that's where you're getting some of this in between action, which is why, as savings continue to fall and you don't see wages really keep pace with inflation, that's where you're going to see some of this degrade. And again, that consumer confidence is going to be the bigger driver, I think, in November and December than it is in October. So if you have any questions, again, always happy to talk. You can find me in the comments section or on Twitter. We appreciate your support and watching this. So we hope you have a great, happy, fun, and safe Halloween. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.